let's talk about one of the big stocks of the day. JSW Infrastructure has made a strong debut on the exchanges. The stock is up around 30-odd%. The issue price was around 119-odd rupees. And you can see that currently it's at around 157-odd rupees. The stock has listed at a premium. Do note that this was the first IPO from the JSW Group in over a decade. To discuss this and more, we have with us Arun Maheshwari, who's the joint MD and CEO of the company, joining in to discuss their plans going forward. Mr. Maheshwari, welcome to the show and congratulations on what has been a good listing. Wanted to start by talking about your balance sheet. Now that you are a listed entity, can you tell us what the consolidated debt on books is for you? How much will probably be reduced? And what is the plan in terms of consolidated debt that we can expect from the company going forward? What's a comfortable figure for you?
Yeah, thank you. First of all, the debt on the book post this IPO is zero. Net debt is zero. And going forward from here on, we will, the opportunity what the sector provides for is definitely great. And especially in India, the sector is sunrise sector. So enough opportunities are coming up. We are considering some of the opportunities, and hopefully we will be getting into this deployment of funds on these CapExes going forward.
All right, you will deploy the funds in CapEx as well, Mr. Maheshwari. First up, congratulations on a strong listing. In fact, it listed at a 20% premium to the issue price, and from now, from there itself, it's seen a further jump itself. I just wanted to understand that, if you compare your margins to peers, they are lower as compared to some of the other leaders. And 63% of your total cargo volumes come in from group companies. So going forward, what is your plan for diversifying beyond the group and improving margins as well?
Okay, so I'll take this question in two parts. First of all, the dependency on the group cargo. So a port sector is a very, very capex heavy sector. And for any port sector to survive, you need to have a solid anchor customer. And what can be a better combination than that if the solid anchor comes in from your own group? See, the genesis of the group when it started in 2004 was largely, as to cater to the supply chain requirement of the group cargo. And over the years, for good 14 initial years, we have been catering to only group cargo. And in the last 5 years, we have diversified as an independent. In fact, 5 years back, our total volume on the third-party business was only 6%. And today it has grown to 37%, wherein the volume has grown 3 times. So the investment rationale or the direction and our intent has been very clear to grow this as a very, very independent terminal, and which we have been able to successfully do that. Now, coming to the percentage EBITDA margin, if I have to understand correctly what you were saying on the margin side, EBITDA margin is one thing, which is, if it's a greenfield port, then definitely in India, if you have to look at most of the greenfield port, makes about 65% kind of EBITDA margin. But ours is a very different model of port development. We are 50% capacity from the greenfield port side and 50% from the terminal side. When I talk about terminal, which are the concession given in the major ports, which is on a 30 years concession with a fixed tariff, fixed commodity, all this stuff. Of course, the EBITDA margins are subdued over there because you have to share a revenue to the major port because of the ecosystem what they provide for, but your capexes are very low. So here what we have adopted is 50% capacity on terminal and 50% on greenfield. We consider the return on capital employed has to be sound, and what we understand that, we have a very robust return on capital employed. FY23, if I had to look at it, it is closer to 20%, which is quite healthy. Even if the EBITDA margin looks subdued, but our capital expenditure is extremely low on the capacity built up.
Okay. Can you just give us what the strategy of the company is then going forward when it comes to business from third parties? Like you indicated, it's increased from 6% to 37%. Eventually, what is the target from when it comes to third party business?
See, we are fortunate they were part of the group wherein JSW Steel, Energy, Cement, everybody is growing very, very robustly. That throws a good challenge. How do we maintain our ratio of the third-party business growth? Not that we are a custodian of their cargo, of the group company cargo, but then definitely being a group company, we get a fair chance to look at the cargo first. And if we are capable, competitive, we are definitely there to handle their cargo. I think the way they are growing, going forward, making 60-40 ratio or 50-50 ratio in favor of the group looks most likely in the coming years.
And there is no margin differential between the anchor customer and third-party customers, right? Or do you give favorable terms to the anchor customer.
Oh, yeah. No. A single, one port, one product, one pricing, whether it's a JSW group or other. If the scope of services are similar, everything remaining similar, there's no discrimination at all.
Okay. So while you have lower margins as compared to your peers and you explained why, what is the margin trajectory that we can expect for the company? What are you targeting when it comes to an eventual margin which would be sustainable, say, in the next year or?
So it will be purely a factor of, how much revenue share we quote for and how much revenue share we get into the bidding in the government terminals. Because going forward, we found this model of 50-50% in the greenfield and terminal as a very sustainable model, lower capex, low gestation, almost zero risk on execution front, and the customer base is known. So we feel that return on capital employed is pretty decent in this kind of model. And depending upon the revenue share, what we quote and what we get the terminal, our margins will be decided. But having an experience being one of the largest terminal holders in India, we expect the similar margins or slightly better margins, maybe a couple of percentage more, we would like to achieve, and we should be there going forward.
Right. Let's talk about expansion then and the current capacity plus volumes. Mr. Maheshwari, what is the kind of volumes that you target to handle in this current fiscal year, in the next couple of years, say by FY26, FY27? So what's your overall volume target? And you have around 9 ports right now. By the next 3-4 years, you're looking at expanding your port capacity as well. How many ports do you intend to reach?
Okay, so first of all, the capacity what we are going to, or the volume what we are likely to handle, FY23 first quarter, June 23, FY24 first quarter, we have handled 25.42 million ton. I believe that gives a very good, fairly comparison, what we are likely to achieve. Generally, the first half is lower in port sector because of the rains across the country. So I think we are growing at a very robust pace, and whatever guidance we have given to the market, we are going ahead with that. Our future growth on the volumes will largely depend upon how much terminals or how many terminals we successfully bid. We are one of the largest, as I said earlier, and we are bidding very aggressively in almost all the terminals, whatever is coming. And the kind of pipeline what the government has offered today under the PPP model to all the private players, I think that leaves a big opportunity for all the players in the sector, be it regional player or pan-India. Pan-India, there are very few players now, but regional players also get a good opportunity. And I think we'll have we would target a good share of it, and we would like to maintain the growth momentum. In the last 20 years, we have grown at 22% CAGR on the volume front, and our ambition would be to maintain that.
Okay, all right, Mr. Maheshwari. Well, thank you very much for joining in and speaking to us. So that is really one of the big stocks of the day, JSW Infra, strong listing there, over 30% higher. They have said that they will increase their ratio of the third-party business, and they do have a stronger balance sheet post the IPO, which is basically net debt-free. We'll take a short break, but on the